And welcome back. We're moving on to the new normal economy now. But just a quick reminder that we also have sponsored roundtables throughout the day. And at 11:30, there's one sponsored by Mitsubishi Electric about the what's next for offices. So now our next guest is Anna Leech, who is Deputy Chief Economist at the CBI. She started off at the Treasury and then worked at the Department of Work and Pensions, working specifically at one period on older people strategy, which is, I have to confess, is of interest to me, Anna. And then for 13 years has been head of economic analysis, then economic intelligence before her latest role. Welcome, Anna.
Thank you. And thank you for inviting me to be with you here today.
Well, especially at such a busy time for the CBI. BESA are members, and we very much value that membership. I'm going to let you get on, do your presentation. I'll come back for the Q&A.
Great, thank you very much. Right, well, good morning, everyone. It's a pleasure to be with you here today. I will be talking you through various things to do with the economy, then starting with the nature of the COVID hit to the economy, the recovery, and some of the challenges with which we're a bit painfully familiar now, some of the permanent changes which COVID has brought as well, and then finishing with the outlook and risks to growth, and then finally a look at the budget and COP26 opportunities taken and missed. So kicking off with that programme, we're in a bit of a strange new normal at the moment where we can go out to restaurants and shops without having to queue up anymore. And our jobs are increasingly feeling like they did before, with fewer masking requirements, more in-person meetings and less social distancing. And yet here we all are at a very snazzy virtual conference. COVID is very much still with us, and talks about restrictions over the coming months are very much live as infections remain very high. And then in many ways, these personal experiences mirror what we've been seeing in the economy. On the one hand, activity has returned at pace and much more quickly than was originally feared. But the disruption of the last year and a half has scarred the economy's productive capacity and left many companies struggling to meet the rebound in demand that we've been experiencing. So here I'll talk you through a little bit of the experience the economy has been through to date before kicking off with where we are now. So it has definitely been a very grueling period for the UK economy. The UK economy actually experienced the worst recession in 300 years last year. And amidst that, there has been a huge inequality of impact, with sectors having very different experiences depending on the extent to which they're dependent upon face-to-face contact with consumers. Regions of the UK, cities and towns have had very different COVID experiences, both reflecting their sectoral makeup, but also reflecting the extent to which they are locations for people working from home. And people have had very, very different experiences. Some have been on furlough, some have been busier than ever, and a very different experience for commuters versus other workers. And amidst all of this, we have seen unparalleled government support, estimated to be above £300 billion. The economy has been through a fairly bumpy recovery so far, as you can see from the shape of the chart. A lot of the initial shape of that recovery reflected the extent of permitted activity, and also the extent to which people were confident to return to shops, offices, restaurants, as and when they were permitted to do so. Amidst that permitted activity, each lockdown's impact has been successively less negative as people adjusted to the new way of living, but also as more and more activity was permitted in each lockdown, with construction and manufacturing in particular allowed to operate more consistently through lockdown. Through this year, we've had a fairly steady reopening of the economy following the very successful vaccination rollout here in the UK. And the economy had largely followed suit. And building on that, the story is actually a cautiously positive one. Positive because, as I said, activity has recovered pretty strongly, all things considered. The economy is close to pre-pandemic levels now. It's about 0.8% smaller as of the latest data from the ONS, which is for August. If you look at Google's mobility data, people are getting out and about to a quite significant degree now. The number of visits to supermarkets and so forth is back above pre-pandemic levels, and getting there for other shops and restaurants. Transport demand is rising. Air travel is picking up, with business travel now starting to follow the slightly slow recovery in tourism traffic. But as we know only too well, the reopening has not been plain sailing. More recently, labour shortages and supply challenges have been a source of escalating disruption for many sectors of the economy, and are making it difficult for firms in those sectors to meet what has been actually quite strong demand and well above normal in a variety of sectors, particularly in manufacturing. Meanwhile, we're heading further into the winter months with very high infections, as I said before, and that presents quite a big risk to the economy, and actually helps exacerbate those labour shortages. You may remember back in the summer, we had the pingdemic, when people were both either off sick or isolating to a very significant degree, with some companies talking about 30 or 40% of their workforce being off. And this on its own has a very significant effect on activity. Indeed, the economy is now estimated to have shrunk slightly in July of this year, when the pingdemic was particularly pronounced. Digging into a bit more of the detail of what's been going on in the economy, the monthly data shows that growth has been driven predominantly by sectors in what we describe as a sort of catch-up phase, which is particularly those sectors in the consumer services part of the economy. Here you can really see the huge distribution in experiences across sectors when you dig down into a bit more of the sector detail. And this shows how output has changed pre-pandemic up to August of this year, with some sectors quite significantly above where they were previously, but a large majority of sectors below to varying degrees of significance. So the sectors which continue to see the largest shortfall in activity are those who have been the last to be allowed out of lockdown. So the restaurants, hotels, bars, leisure services, and so on. Administrative and support services and transport have also been showing very large shortfalls still. And some of that is affected by the pace at which people are returning to the office and resuming air travel, with train journeys also remaining below normal. By contrast, manufacturing, construction, and some other business-facing services are much closer to pre-pandemic levels. And as I mentioned before, this in part reflects the longer period these businesses have been able to operate, or the extent to which operations could continue in a remote environment. Meanwhile, as I mentioned before, huge regional differences have been a feature of the recovery to date and the extent of the impact in the first place, and those differences are persisting. Currently, around 20% of the UK population is still working from home, and remote working is typically much higher in London, a city which has definitely lagged recovery compared to other cities. And cities themselves generally in the UK have lagged recoveries in towns, cities being much more vulnerable to working from home than other areas of the UK. This shows up in footfall data as well. And this has fed through into sectoral performance in other parts of the economy. So the switch to home working and the expectation that hybrid working is here to stay has fed into the housing market and left its impact on household spending patterns. So we've seen over the course of this year demand switching across to larger properties further out of city centres with scope for home office space, with bigger gardens, as people accept and indeed desire a larger weight of home working in their working experience. But digging down again now a bit more into how the nature of the supply disruptions that have been escalating during the course of this year. So you can see very starkly here on this chart how global shipping costs have been affected by COVID disruption in particular. We've heard talk of, as well as measured data of, huge increases, unprecedented increases in the cost of shipping containers. And these were in particular displaced by the constant global borders opening and shutting, which left shipping containers in the wrong place at the wrong time. And it has taken far longer than many were expecting for those shipping containers to start to move back to the right place. Indeed, that does not seem to be evident at all in this kind of data. And as well as having impact on shipping costs, it is having an impact on the availability of materials components. We've seen this concern escalate again in our latest October manufacturing survey, with 64% of firms concerned that access to materials or components could limit their output over the next 3 months. A very stark number. And companies tell us that they see little sign of this situation improving significantly, certainly before the year end, and indeed into next year, and possibly through to the year after. And there are some sector-specific issues that have exacerbated problems for example, car companies who've been affected by semiconductor shortages, which relate to both the issues I've just described, but also more specific issues like problems with factories, fires, other natural events, hurricanes, the fact that then Chinese car producers bought up all the available semiconductors because they reopened earlier, because semiconductor production was directed towards games consoles and hasn't been able to switch back to car production. It's had a huge impact on car production globally. And in the UK alone has left car production in September over 40% below levels a year ago. The global reopening of economies has also led to rising increases in global commodities as well, which have fed further into escalating cost pressures on companies who've already been hit hard by COVID. Obviously, energy prices in the UK have been of particular concern in recent weeks. And they were rising ahead of the issues that have risen to the fore more recently. In the UK, we're experiencing both global issues with natural gas, which reflect the fact that globally winter was quite cold last year. We've entered this winter with very low stocks. In Europe, they had a very hot summer with very low wind. In the UK, we have a very high reliance on gas for power generation and especially low gas storage capacity. So the UK is particularly vulnerable to gas prices. and which is why electricity prices have risen faster here than elsewhere. There have been also some UK-specific challenges, for example, a fire that knocked out a key interconnector. And if this winter turns out to be cold, and it's certainly a chilly day in my neck of the woods today, then we could see those rising prices really starting to bite for businesses in particular, as the government seems quite keen to cushion the impact on consumers, at least in the near term. This combination of supply issues is having a real impact on businesses' ability to meet very strong demand as the economy has recovered. In our manufacturing sector, we've had stock adequacy reported as close to a record low in the most recent data, and those records go back to 1977. In the distribution sector, it was reported that stock adequacy in October was its worst on record since 1983, that is, with 43% of companies in the sector describing stocks as too low. The supply chain issues are also leading to lengthening delivery times and more generalised inflationary pressures, as companies are seeking to recoup some of their rocketing costs by passing those costs on through the supply chain. And this has been feeding through more prominently into concerns about inflation. We saw one of the sharpest rises in inflation in August for several years. It did ease off ever so slightly the following month and is around 3.1%. And the Bank of England are due to make a monetary policy announcement this Thursday, alongside the launch of their quarterly monetary policy report. Against this backdrop, inflation has been rising this year and is expected to pick up further later this year. I will say at this point that there are several measures of inflation. I'm sure many of you will look at this chart which peaks at around 4.5% and go, how on earth does this relate to costs that I've been seeing, where prices have been jumping 20%, 30%, 40% over and over again? And all I would say is this is consumer price inflation. It is a balance of of the prices consumers face across goods and services that they consume. And in that sense, it smooths over some of the cost prices that companies are feeling at their front door. And this is the measure that the Bank of England pay most attention to in terms of their decision making, but they are very alert to the extent of the prices and cost pressures that companies have been experiencing. And they have been very concerned in their communications recently that inflation could rise and stay high for a greater degree than they expect. So in that sense, they're expecting inflation to rise to 5-6%. And to stay there through to the middle of next year. But they do expect these inflationary pressures to be transitory. The supply chain pressures, the frictions that are feeding these huge price rises that many companies have been experiencing, do reflect the disruption of COVID. And as COVID and it becomes a more manageable condition, those disruptions will dissipate and their impacts likewise. On to labour shortages now, another issue that many companies have been grappling with. You can see here the chart showing the latest data on job vacancies, which have really hit the news month on month, as each month has seen a new record set for the number of vacancies in the economy. They currently stand at 1.1 million, which is about 40% above where they were pre-pandemic. Now, a lot of these vacancies relate to the pace at which the economy has reopened, and some of it could prove to be more structural, i.e. more long-standing. So, for example, with hybrid working, That leads to more people working from home, of course. It leads to them spending more of their money locally. That means for the likes of Pret, for example, need to increase their regional capacity and reduce their city centre capacity. But will the people move, is the question. We don't know, because this hasn't happened on this scale before. We've also been through Brexit in the middle of the pandemic, which has obviously had an impact on the availability of labour, with it being a particularly prominent concern in relation to HGV drivers. And the UK entered COVID with long-standing skill shortages too. IT workers, engineers, chefs, those in construction, and drivers, of course, to name but a few. And as a result, we're seeing survey records for the share of, for example, manufacturers saying that labour shortages could constrain output over the quarter ahead, and of services companies saying they're worried it could constrain investment. The question is, what does all of this mean for pay levels? We obviously are familiar with the rhetoric which the Prime Minister has been behind, where he's calling for a high pay society. But that pay does need to be sustainable, and productivity is the route to pay sustainability. Because otherwise, if pay goes up and productivity does not follow suit, all that happens is the Bank of England puts up interest rates, and we're back to where we started. The official data is a bit complicated on pay at the moment. There are some base effects because we saw a lot of low-paid jobs lost or furloughed during the crisis, and they came out of the data. And then we've got employees now coming back off furlough into their jobs and their pay resuming previous levels, and that's leading this rather spiky path in recent pay data. So this pay growth that we see here of 7% plus is not reflective of what's really going on at ground level. Pay settlements have not picked up substantially to date. Our surveys suggest that firms are responding to labour shortages with targeted pay rises for key roles rather than widespread ones, with average settlements in the 2 to 3% range. Meanwhile, there is data suggesting that there's actually quite a lot of labour supply left, not necessarily available, and that is the question. Employment remains below pre-COVID level. There are still 136,000 more people unemployed compared to pre-pandemic, and over 500,000 people more inactive, mostly the over 50s. And at the end of September, over 1 million people remained on furlough right through to the end of the scheme. So it's not clear whether these people who are out of work will return to jobs or not, how available they are for jobs, whether they're in the right place with the right skills for jobs. Turning briefly now to the underpins to the economic outlook. Looking beyond the supply challenges I've described, demand is actually quite strong. Order books are quite healthy and actually historically strong still, although they have eased off relative to the peaks they reached. Household spending is at the heart of our forecast, and many people's, because of the quantity of household savings that were built up during the course of the pandemic, when much of the household's usual spending opportunities were fundamentally constrained. We're expecting households to run down more than 10% of their excess savings over the course of this year. And despite the supply chain frictions, there's even been an encouraging revival in business investment. Investment plans in our surveys have improved strongly over the spring and summer and remain particularly strong for IT. Much of that improvement is related to the worst of concerns and uncertainty surrounding COVID, alleviating. And amidst that, corporate balance sheets, at the aggregate level at least, are pretty strong too. So there is actually some upside positivity for investment. But nonetheless, it's still the missing piece of the recovery in our forecast. It hasn't recovered to pre-COVID levels. By the end of our forecast, which at this point went through to the end of the year, it has more ground to recover. It fell by 22% during the crisis, and even further in Q1. There's lingering uncertainty over the long-term impact of COVID. And so it doesn't quite get back to normal levels at the pace of other components of GDP. Another key driver of the recovery for the UK, of course, is what goes on the global front. There's been the disruption arising from supply chain frictions, as I've described. And Brexit continues to arrest some of the recovery we might otherwise expect, given the strength of the recovery we've seen in big players in the global economy, such as China and US, and more recently in Europe as they have caught up with their vaccination programme. Bigger risks on the trade front going forward stem from the likelihood of our divergence in the global economic recovery. This reflects differences in progress in the rollout of vaccinations. In China, this is starting to have material impacts on their activity and its recovery, as are energy costs in China, which is a very energy intensive corporate user. In the US, it's more a sign of the maturity of their recovery, when we look at the extent to which the pace of activity has eased off in recent months. As I said, in Europe, they had been lagging behind due to the vaccine rollout, but their recovery looks a bit more sustainable, with the Delta variant seemingly better contained than is the case in the UK. So overall, we do expect the recovery to continue further ahead. Our forecast in June was looking at growth of 8% this year and 6% next year, which is not at all bad, all things considered. The OBR have just published their updated forecast, giving us a clearer picture of the UK economy as it recovers. And they're cautiously optimistic too. They expect the economy to grow by 6.5% this year, driven by consumer and government spending. And they remarked particularly on the resilience of the labour market, with unemployment much lower than they were expecting and very supportive to the UK's economic recovery overall. But the UK has many long-term challenges that have persisted during the course of COVID and have indeed been exacerbated. What we see here is how the UK economy's trajectory changed after the financial crisis, putting us on a weaker growth path. And that does not change in our outlook. And there are a lot of opportunities for the UK as we look to move beyond COVID to try and get a sharper upward trajectory for growth and get that higher wage, higher performance economy that the government is so keen for us to engage in. In May, we launched our Seize the Moment economic strategy at the CBI, and there are a huge list of opportunities for business and society.
Yeah.
A decarbonised economy.
We're out of time.
Okay.
But I think you were pretty nearly at the end anyway, when that was the final slide.
Yeah. Yes, that's right.
Thank you very much. Fascinating on the economy, and thank you very much for your time. And I'm sure we will send you over some questions as we get them through to do that. But
Sure.
Thank you very much, Anna Leech from the CBI.
Great. Thank you.
Thank you.